all the warning signs are flashing red. It's just a matter of how long can the market continue high. The gold stocks will do significantly better than bullion. Well, the Fed is increasingly boxed into a corner. My base case would be 50, but I don't think 75 is off the table. I truly find it difficult to envisage a scenario in the next 12 months where gold will be lower. And that makes me nervous.
Go over some economic data and get the outlook for Fed policy, economic growth, and stocks. Adrian Day joins us right now. He is the president of Adrian Day Asset Management and the portfolio manager of the Euro-Pacific Asset or Gold Fund. Thank you for coming on the show.
Thank you very much for having me, Dave.
I look forward to every time seeing you in person. This is different. I know we talk online all the time. I haven't spoken to you in a while. Last time I spoke to you, gold was not at $3,600. It is now. I get your reaction to that. Let me get your reaction to this piece of news. The dollar is set for the steepest weekly drop in a month. This comes we're speaking a week before the Fed meeting. The Fed meeting is on the 17th of September. Different forecasts show different, rate cuts throughout the year, or different levels of rate cuts throughout the year. Morgan Stanley, for example, is now revising their forecast to 3 cuts this year, up from 2. But the consensus is that they will cut at least 25 basis points next year. This comes as inflation came in this week at 2.9%, which is higher than the previous month at 2.7%. So it's beginning to show a trend of higher inflation throughout the year. And as we see earlier in the week as well, payroll numbers came in weaker than expected. The initial claims data came in. That was the highest in 4 years, weekly initial claims, highest in 4 years. At the same time, the BLS has revised down their March 2024 to March 2025 payroll numbers by 911, almost 1 million jobs down. So weakening labor, higher inflation, lower dollar. What is the Fed going to do in this environment, you think?
Well, the Fed is increasingly boxed into a corner, obviously, because of, the mandate to try to keep rates high, to stifle inflation, but help the economy, and particularly the labor market, which is what Jerome Powell seems to be more focused on, the labor market, rather than other aspects of the economy. I mean, personally, I think they should have had a quarter point cut already. That would have helped ease some of the pressure. As I say, they're boxed into a corner, so my sense is that they're going to cut a quarter of a point. And we're probably going to get another 1 before the end of the year. I'm not sure we're going to see 3 cuts before the end of the year. I'm not sure we're going to see a half point. Some people are talking about a half point next week. I tend to be relatively cautious on that. I would think we get quarter of a point. Powell is still going to talk in the press in the press conference. He's still going to focus on inflation. But clearly, what's happened since the last Fed meeting and the last Fed conference, and the last press conference, clearly the labor market, you can't hide the fact that the labor market is weaker. Now, when you and I had dinner, we talked about the labor market. I've been saying for months that I think the labor market is a lot weaker than just a headline new jobs and unemployment number would suggest. A lot.
Well, you turned out to be right. How did you?
But there's no. I'll mention. Yeah. But what I'm saying is, Powell, was it 2 months ago now? He kept referring to the labor market as solid. You cannot say that anymore. So that to me is the biggest thing that's clearly in front of us all. Well, it's as I said, it's just lifting the bonnet or the hood, and you look at the characterization of the jobs. A majority of jobs being government jobs or part-time jobs. You look at people who were accepting part-time jobs, and over 3/4 of people taking part-time jobs had been looking for a full-time job. So all of these things were, and then the other thing was continuing claims. So while new claims were not that bad, I mean, they have been recently, but were not bad, the continuing claims were bad. No. And the length of time it took people who lost a job to get a new job was just getting extended and extended and extended. So those were the things really, just looking behind the headline number, it was pretty clear that it was not a strong labor market. And then anecdotally, just talking to people, Yeah.
Let's suppose they cut by 75 basis points, which is something, not maybe immediately, but maybe this year, right? Would that actually help the labor market?
That's a good point. And 75%, I mean, my base case would be 50, but I don't think 75 is off the table. I'm not sure if I mean, obviously, everything is helpful at the incrementally. It's all helpful at the margin. But I don't think a 25 or 50 is going to do anything for the labor market. 75, maybe does a little bit.
Well, here's my other side of the question here. What will 75 or even a 50 basis point cut do to inflation?
Well, I don't think inflation is going to run away from us, but I mean, it's clear if you look at the last year, it's been stubborn ever since we had the big drop post-COVID. The CPI and the PPI have been stubborn, and they've been inching up for the last 5-6 months now. They've just been inching up, and I don't think that has an awful lot to do with tariffs, frankly. The problem is if unemployment moves up meaningfully, then people have less money to spend. And so if there's less demand for goods and services, that acts as a bit of a brake on prices going up, on inflation, what's commonly called inflation. So I'm not expecting inflation to run away. But, at the current level, we're almost 50% above the Fed's own target.
Yeah.
And that's if we believe the Fed's numbers.
Sure.
Or the government's numbers. So we're already 50% above the target. And I do think, again, Powell is definitely focused on inflation as much as he's focused on the labor market. So I don't think he wants to be too aggressive at this point.
I've heard the opinion that the real reason Trump wants rates lower is because of this $1 trillion interest expense that they're not getting away from. That's higher than the military spending now, defense spending.
Right.
And so it's going to look very bad for their mandate to lower the deficit when they've got a $1 trillion, burning hole in their pockets every year just from interest expenses.
Right. No, absolutely. And I mean, I've always said that, that's one of the main reasons that rates just simply have to come down. Because we all know this, or increasingly we all know it, but you look at all of the bills that Janet Yellen issued, and she only issued bills. She issued very, very little at the long end. And so if you've got a 5-year bill or a 3-month bill that was issued 3 or 5 years ago that's coming due now, we've got an average interest expense, I think, now of about little under 3.5%, I think, is the average right now. The latest number I saw. Well, anything that was issued 3 or 5 years ago, rolling over today, is going to be at a higher interest rate.
Yes.
And so just without doing anything, without extending the terms and maturities or anything, whatever you do, just by the bills rolling over, that interest expense is going to move up. And that's without the deficit going up or anything else. I mean, and as you know, Scott Bessent, the Treasury Secretary, has been using all of the, bag of tricks that Treasury Secretaries use, and he's employed a couple of new ones, the stable coin, what was it called, the Genius Act, to encourage and have light regulation on stable coins that are fully backed by treasuries. No, that's a clever way. That's one way to get more demand for treasuries. How much does that do this year? I really don't know, because you've got to set up your coin. Presumably that takes a bit of time.
Sure.
You've got to get through the regulators and get approved, and then you've got to market it. So I really don't know how much you get out of that this year. Let's just say 250 billion to be nice to them. The reduction in reserve requirements on the banks, the whole point of that was to get banks to buy more treasuries. But I don't think banks want to buy more treasuries. They're underwater on the treasuries they own because they're holding them to maturity. They're underwater on what they own. Jamie Dimon, CEO of Morgan Chase, has said he has no intention of buying, or has no interest in buying more treasuries. But again, that was one of the tricks that they were trying to use, reduce the reserve requirement and buy some more treasuries. But maybe that adds, 50 billion maybe. And there's other little tricks and gimmicks that they're using, but they're not getting up. They're not getting close to how much is going to be sold between now and the end of the year. And I think the bigger story than what does the Fed cut rates by 0.25% or 0.5%, the bigger story is, will the Fed institute QE again? They won't call it QE, of course, and Powell has said quite firmly last time, he said, it's not the Fed's business. We don't think about the deficit, he said. It's not our business. That's the administration's problem or business. That's just, if I may say, BS. Of course they think about the deficit. They might be blaming the others, Congress and the administration, for the deficit, but of course they think about it. And so I think the biggest story is, will the Fed turn to QE to mop up?
Show you this remarkable tweet that Trump made. Well, not tweet. He posted this on Truth Social. The Fed had followed what we published. If the Fed had done what we published, they would have raised rates in early 2021. The entire organization is broken. It needs to be fixed. They need to use modern sources of information. We strongly disagree with Ken Griffin. We think incompetence is more important than to defend theoretical independence. He, too late, I think he's talking about Powell, has done a terrible job since he adapted a two-target. It's too low, it's too rigid. They follow data that's years delayed. They don't believe that money supply matters. It's like the Pope not believing in Jesus. We think that's a bigger problem than this notion that they are dependent. Anyway, he doesn't want the Fed to be independent, as you know, and he wants lower rates. But just evaluate that remarkable attack. Scott Bessent at the same time was also, he tweeted a couple of days ago, Scott Bessent tweeted that the Fed is singularly at fault for the rising inequality in America.
Singularly at fault. I absolutely think the Fed is at fault for the widening. I gave a speech back in 2008 where I said these policies will lead to widening inequality. So you didn't have to be a genius to see it, and I think they're absolutely right. Fed's policies are widening the inequality. I'm not going to talk about exactly what Trump said and everything, but I think that comment about relying on data that's late is absolutely true. Again, I've been saying that for months. When the Fed says, and Powell says it, Bernanke said it, when the Fed says we're data dependent, what that means is we're looking at data that already reflects something that's happened. If you're looking at labor market data, you're looking at stuff that reflects maybe 6 weeks ago.
Right.
Now, when you have the first and second revisions, and it's only the third revision that is anywhere close to reality, then you're looking at data that's already 3 or 4 months old before you get an accurate picture. If you were to act on the labor market reports when they first come out, knowing that they're going to be revised twice, but you'd be acting on wrong information, right?
Yes.
If you only act on the first month's numbers. And so I and other people like Daniela DiMartino Booth, and I don't want to put words in other people's mouths, but a lot of people have been talking about the fact that relying on data that is revised, always revised, and massively revised for 1 or 2 months means that you are always looking at a situation that existed 3 months ago.
Yes.
I have made the comment, not facetiously, by the way, but some of those 400 PhDs sitting in the Eccles building, the Fed's office in Washington, D.C., could be better employed by picking up the phone and calling companies and asking them what's happening, or listening to conference calls, or reading their own friggin' beige book.
Yeah.
That's the Federal Reserve's beige book on the state of the economy. I don't think the Fed takes any notice of that. They wait for the data to come out, which is always late.
This is just completely off topic, but just funny anecdote, not anecdote, but piece of news this week. The Labor Department is now hiring a watchdog group to evaluate how the BLS is collecting data after they got rid of their commissioner. So,
well, I'm not commenting on, I don't know whether she should be fired the way she was fired, but clearly, I've said this to you before in our last conference, I'm not suggesting it's a political hack job to try and make Trump look bad or anything like that. But clearly there's a problem with their methodology.
Yeah.
Clearly, 900,000 jobs that we said were created, oops, they weren't. And the year before, 800,000 that we thought were created, oops, they weren't. Well, there's something wrong with their methodology.
True. Very good point. So the dollar, the fact that this is another opinion that I've heard, the fact that the White House is at open war with the Federal Reserve does not spell confidence for the DXY.
Correct.
It's already down, 12-13% year to date. This decline is likely to continue, says this theory. What's your view?
Yeah, well, to me, frankly, you had in the first half of the year, and obviously we all look at calendar quarters and years, which is, but in the first half of the year, that was the largest dollar decline since 1973. That's pretty astonishing when you think about it. The largest first half decline in, 50 years. I honestly thought there'd be a bounce. The fact that there has not been any kind of meaningful bounce, there was a little bounce in mid-August, you saw that, and then it quickly reversed. The fact that there has not been a bounce after a big decline like that, and now further declines, suggests to me that the appetite for dollars is very, very weak. And let's remember, for 40 or 50 years, foreigners have been just, until the last couple of years, have just been steadily accumulating dollars. Mm-hmm. And it might be, central banks, but it's also asset managers who are putting, if you're a British asset manager, or Swiss asset manager, a lot of your assets are put into the US. And that appetite has gone away. So if they just stop buying, we see a decline in the dollar. But, after you've had to, I'm thinking of it as an asset manager now. You've had, maybe you're a British asset manager and you've had 50 or 60% of your assets in the US. You've got 50 or 60% of your assets in the US. If you buy a US stock, you're buying a dollar, of course, right? You buy the dollar to buy the stock. You've had the strongest stock market in the world.
Yeah.
Now you're getting sense that maybe they're not so keen on having us in their market. Maybe you're nervous about the dollar. Maybe you're nervous about the stock market. But for whatever reason, it's not a bad idea to reduce your exposure to the US at this point. And you multiply that across the board. So yeah, I think the dollar's going to continue to be weak. And remember, the thing is, to the extent that the US loses its reserve currency status, and it doesn't have to, it's not either it's the reserve currency or it's not. That was the way with the pound up until 1945, where we switched from the pound to the dollar. But it doesn't have to be all or nothing. And of course, people smarter than I am talking about the multipolar world and the bipolar world and so on. So the dollar can partially lose its reserve currency, if that makes sense. And to the extent it loses its reserve currency, all of the dollars that have ever been created still exist. But to the extent that it loses that reserve currency, those dollars will start to come back to the US.
Yeah, that's a great point. That leads me to my next question. Foreign central banks hold more gold than treasuries. That's a trend that's been recent, right? This is for the first time since 1996. We saw this yellow line overtake the blue line, which is U.S. Treasury holdings as a percentage of total foreign reserves. To your earlier point, what would happen for this current trend to reverse?
Yeah, I think there's a problem with that graph, to be honest.
Okay.
And that might be looking, I don't want to get too technical into it, but if we're looking at dollars, the dollar was 75% of central banks' foreign reserves back in 2000.
Okay.
And that graph doesn't show that.
I see.
If you look at the dollar as a percentage of central bank reserves, it's still about 47%, down from 75% at the beginning of the century. In 1999. But, there's no question that the percentage of dollar reserves has gone down dramatically, right? 75% in 1999, 65% 5 years ago, 55% 3 years ago, and now under 50%. So it's been a long-term trend. And I think it's fair to say that nothing Trump has done has stopped or reversed the trend, but it didn't start with him. It's a long-term trend. And similarly, in the last several years, 4 or 5 years, we've had that trend towards higher gold. And again, that's a critical point, because what's happening is gold is replacing the dollar as the central reserve asset, which is part of being a reserve currency. Part of. The other part has been the the currency in which trading is done. That's also the percentage of world trade that is conducted in the dollar has also declined, not just this year, but over the last several years. And so even though most world trade is still conducted in the dollar, and even though the dollar is still the largest reserve asset, the trend is definitely, the trend is definitely towards a reduction, and that means that the dollar it's losing some of its reserve status.
Well, let me just present a bear case for the gold price then. So suppose central banks have bought enough gold, right? This trend isn't dependent on, in fact, the 10-year real interest rate, as we both saw in the keynote presentation here, has been trending up alongside gold. So it's not due to the fact that interest rates in real terms have been declining. In fact, quite the opposite.
Correct.
Central banks buying because of de-dollarization and moving away from the Trump policies. Once that trend finishes, that's the end of the gold price run.
Well, no, it's an interesting point, and the question is when do central banks stop buying dollars? But you mentioned Trump policies. That's the thing I want to really emphasize. This move didn't happen with Trump. It's been going on for years before that. We know the weaponization of a dollar. Everybody talks about the weaponization of a dollar as though it started with the seizure of Russian central bank assets, which was, of course, under the last administration.
Yeah.
But it's been going on for years, where the U.S. is increasingly, if I can say it without offending people, increasingly acting as a bully in the world. When you see a Spanish bank that lends, a French bank that lends money to a Spanish company to build a hotel in Cuba, which is legal under Spanish law, legal under French law, legal under EU law, legal under UN law, and legal under Cuban law, for what that's worth. But the US fines the French bank for having the temerity to lend to a company that's investing in Cuba because it breaks US law, and they can enforce that because the bank used the SWIFT code, the SWIFT system. That's just one example. But so what I'm saying is the US has been acting like this for years. That's 15 years ago. So nothing Trump has done has slowed it down or reversed it. But I want to emphasize it didn't start with Trump. Now, that's not a political point I'm making. The point I'm making is that the willingness or eagerness of foreigners to divest from the dollar is a fundamental thing. It's not something they're saying, well, gosh, we've only got 3 more years of Trump, let's just hold on. And so to get back to the point, 47.5% was the last number that came out on the amount of dollars in foreign reserves. We're talking foreign reserves of central banks. So under half. Now, if the reason you're diversifying, you want to diversify away from excessive concentration in an asset about which you're nervous, exacerbated by weaponization of a dollar, the question is, what is too much? Or what is enough? If you're really worried about weaponization, if you're Kazakhstan or, you're a country that potentially is at risk, I would argue anything is too much, right? If you're simply worried about, the dollar deficit, the weakness of the dollar because of the twin deficits, maybe 47% is still too much.
Yeah.
So I think we've got a long way to go before central banks say, okay, I'm comfortable with the dollar assets that I hold. And of course, as the dollar goes down, partly because central banks aren't buying anymore and some of them are selling, as the dollar goes down, that only makes a normal person say, maybe I don't want as much as I have.
So now that markets, I'm talking about not just gold and silver, which we'll get into in just a bit, but Bitcoin stocks, now that markets have run up so high in 2025, what are the key data points or trends you're looking for either a continuation of this bull rally or a reversal? In other words, what are you basing your investment decisions on right now?
Yeah, well, I think one thing definitely will be weakness in the economy and how weak the economy is, because whatever people want to do, if they don't have the money, they can't do it, right? That definitely is one thing. I think the U.S., I don't know if this was the question, but I think the U.S. stock market is potentially reaching the tipping point where the leaders will roll over and we'll see a correction in the S&P. I'm not looking for a crash or collapse, but we'll probably get rotation out of those leaders. Valuation is obviously one factor, but valuation, you could have said that a year ago. Market breadth is another factor, but again, you could have said that a year ago. Now, the market breadth is worse today than it was 12 months ago, but still, those things, the valuations and the market breadth are just continuing to get worse. The other factor, of course, is insider selling. When you see an extreme ratio, which we're seeing now, an extreme ratio of inside buying to insider selling, that is another warning flag. So I think all the warning signs are flashing red. It's just a matter of how long can the market continue high. And I don't look at it as a prediction. I look at it on a matter of risk reward. And so I just don't think there's so much reward left in the market now. But the higher we go, the more overvalued we get, the more risk there is. And particularly if you look at it as a starting point, if you start from a much higher valuation, your returns over 10 or 15 years are inevitably going to be lower than if you start from a lower valuation.
When you say rotation, what could they be rotating to?
Things that have lagged and things that are undervalued. So that would be smaller cap stocks, value stocks that have lagged, income stocks that have lagged, commodities, of course, that have lagged tremendously. I mean, the ratio, we've had a big run in commodities recently, particularly gold and silver. Yeah. But if you go back to, let's just look at it in the long term, and you look at a 100-year graph of commodities and commodity stocks, commodities number one, commodity stocks number two, versus financial stocks, so the S&P or the world, the MSCI Global Index, we're at 100-year lows, 100-year lows. And if you look at a graph, yes, there's been a little bit of a tick up in the last 3 months, but essentially we're at 100-year lows. Well, so those have definitely lagged.
Okay, so stock market, the leaders are overvalued a bit. What about the bond market? If you're of the belief that maybe inflation will continue to rise, will the 10-year or the long end of the curve follow inflation?
I think there's so much. First of all, I'm not an expert on the bond market, but I think there's so many factors that go into that, and part of it really depends on what the Fed does. Okay. Does the Fed do yield curve control and try to bring the long end down, or does it just mop up as many short-term treasuries as it needs to mop up? I don't know what the Fed's going to do, but I think a large part of the answer to your question is what the Fed chooses to do.
Well, you are an expert on mining stocks. Let's talk about mining now. The fact that people have told me, look, first usually what happens is the gold price moves up, then you got the seniors, and then the juniors start to move with it. That's exactly what's starting to happen now. Yeah. Does that then signal the end of the bull market?
No, absolutely not. And you're absolutely right. What that typically happens. But remember, the really important thing for people to focus on is that U.S. investors, the ordinary everyday U.S. investor, the ordinary everyday registered investment advisor, who's not a gold bug or a gold expert, the family offices, they have only just started moving towards gold. And so when the dentist in Oklahoma calls his broker and says, hey, Joe, I think we ought to have a little bit in gold. And Joe, who knows nothing about gold, and says, do you really think so, Fred? Yes, I really want to. What does he buy? He doesn't buy the stocks that are at this conference. He buys Barrick or Newmont or the GDX. He buys the big stuff. So I think the larger companies still have a lot of room to go. Normally, you're right. Normally, after 3 years of gold appreciation and 90% appreciation in the stocks, those stocks will be overvalued and it will be time to move down. But we haven't had the market participation until just the last few weeks. And if you look at those big cap stocks, they are still good value.
Yeah.
Now, after 90% increase in the price, they're not as good value as they were at the beginning of the year.
Yeah.
But I think we've talked about this before. Remember, Oscar Wilde said too many people focus on price and not value. So when the price of gold moves up, the value of the reserves in the ground move up.
Sure.
The value of the production moves up. When the margins expand the way they've expanded, look at the margin expansion. The oil price has not gone up anywhere near as much or is flat.
Yeah.
So the margin expansion has been tremendous. Companies with all-in sustaining costs of $1,850 or $1,900 or $2,000 even, they're making, $1,500 margin. And so your cash flows are going up. Well, when that happens, your price to book value and your price to NAV and your price to cash flow, those valuations don't go up anywhere near as much as the price of the stocks have gone up. Mm-hmm. And so the stocks, if you look at a stock like Agnico, which is my favorite example, because there's nothing wrong with Agnico, right? You can't say, it's cheap because, like you can with, say, Barrick. It's cheap because of Pakistan or Mali. So you look at Agnico and you look at their price to cash flow, right? Their price to cash flow today is a little higher than it was last year. But other than last year, it's the lowest price to cash flow has been for 10 years. So these stocks on a historic basis, on their own historic valuation metric, are not expensive at all.
Okay, I understand what you're saying. I don't mean to be facetious with this next one, but everybody I've talked to at this conference agrees with you. A contrarian might say, that's a topping indicator.
You know what? It's interesting you say that because I have thought to myself, and I've had conversations with people, the fact that I cannot think of a long-term bear case for gold makes me very, very nervous.
Even at $3,600?
Yes. I think we might get a correction, as I said, if Powell tries to act hawkish, although frankly I think the market takes less and less notice of the Fed.
Yeah.
But if they try to act hawkish, that there might be a correction. Might be a pullback, not a correction. But I find it difficult to think, I truly find it difficult to envisage a scenario in the next 12 months where gold will be lower. And that makes me nervous.
It makes you nervous. How do you feel about silver? If you feel nervous about gold, then you should probably feel more nervous about silver's run up.
Yeah, no, absolutely. And silver, of course, can be a lot more volatile than gold for a lot of reasons. Because of the holders of silver. I mean, the central banks aren't going to suddenly reverse course and start dumping it. You obviously saw the World Central Bank. They have a self-interest, of course, but the World Central Bank survey of central banks.
Central Bank.
Sorry, the World Gold Council. Sorry.
Yes.
The World Gold Council survey of central banks.
Yes.
And not one that answered the survey said they intended reducing their gold position next year, and about half of them said they intended increasing their gold position over the next year. So the trend, people can change their mind, of course, but I think the trend for central banks is to continue to buy. The trend for the economy in the U.S. is towards an economic environment that is more conducive for gold. a weaker economy, lower interest rates, higher inflation, weaker dollar. That's an environment that is conducive to gold. It's difficult for me to envision, frankly, something that will happen over the next 12 months to make gold meaningfully lower.
I interviewed you in Vancouver in January of this year. So beginning of the year, I asked you, closing off the interview then, what you would prefer at the time, gold versus the miners, seniors versus the juniors. You had said the miners, given how undervalued they were relative to the price of the bullion. You turned out to be correct, given how far the GDX and GXJ have moved up relative to gold and everything else this year. So that was a good call. I'll ask the same question to close off the conversation. Now with the GDX up 90%, are you still favoring the miners versus gold?
Yes, I will always say what I always say. If you don't have any physical, you should have some physical, but physical is a savings, physical is an insurance. Definitely the miners, and I'll tell you why. If you look at gold, gold has gone up 40% in the last 18 months or something. The gold stocks have gone up 90%. Mm-hmm. So that's a little over 2 to 1 leverage. Mm-hmm. The last time gold went up 40%, the gold stocks have 3.5 times leverage. We have not seen the leverage that we're used to seeing with the gold stocks. Yes, 90%, no one's complaining about that. It's great. I don't want to...
Short sellers are complaining.
It's great. Yes, short sellers are complaining. But what I'm saying is we still have not seen, because of a dramatic move in gold, I mean, that's a very, very dramatic move in gold we've seen in the last 3 years, a very unusual move for gold. Gold is an asset that shouldn't double in 3 years. And the leverage that the gold stocks have shown so far has been significantly below the traditional leverage the gold stocks have shown to bullion. And the reason for that is obvious. It's because of the people who've been buying bullion, central banks around the world, Chinese non-official buyers, are not interested in buying North American gold stocks. And so the gold stocks have just not had that leverage. So yeah, I think the gold stocks will do significantly better than bullion.
Good. Well, thank you very much. What are you looking at these days? Where can we follow you, Adrian?
Well, the best place is adrianday.com.
Yeah.
And then we talk about the newsletter and the money management.
Well, what's next on your newsletter? What can people look forward to?
What's next?
Yeah.
I've got to get through this show yet.
What are you interested in these days?
Well, definitely the gold space. The Tether investment into Elemental and the merger with EMX has very. We haven't talked about
very briefly. Why is a stable coin company getting into gold?
Well, good question. That's a good question, and I mean, I think they want access to gold, whether it's physical gold or gold royalties, to back their stable coins, and they're very interested in gold. I think that is a very, very exciting development because it brings a whole new set of eyeballs, the crypto crowd that's never even thought of gold or gold miners. It brings a whole new set of eyeballs onto this space.
Okay, well, let's keep that on that development. But for now, follow Adrian Day at the website in the link down below. Thank you very much, Adrian.
Well, thank you, David.
It's always a pleasure to see you in person, so happy we had this conversation. Thank you for watching. Don't forget to like and subscribe.